of course, here in India, we at the moment do have a small preference for bonds, government bonds specifically over equities. But of course, as we showed the chart, that gap, of course, continues to narrow. But I think the bottom line here is, I think investing for us is about thinking about how two big themes will impact us. Number one is trying to differentiate between whether this is a slowdown or the start of a deeper downturn. We think there's a much higher chance than not that this is a slowdown that will dissipate as policymakers come out and support. But the second theme, of course, is a new search for yield. And while that may be a theme that's playing out very much in developed markets today, we think that, of course, has implications that should be positive for the rupee and potentially, of course, for bonds as well.
So my only submission is this market is full of surprises. It is going to surprise you tomorrow morning. It will give you another turn. It will give you another kick. Whether it gives you from the front or the back, I don't know. From the left or the right, I do not know. But one thing is for sure, we are undergoing a phase of malnourishment from an economy, from a healthy child. The child was never obese. The child was healthy. Okay, the child was put on an excessive diet, and that excessive diet is monetary tightening. Same time last year, we had monetary tightening. Now we are seeing easing. That result of excessive tightness had led to suck out of money from the system, and that suck out of money in the system has had all its ramifications, NBFC, banking sector, all of that. Now having recognized that there is an ailment of malnourishment, it is important that the government and the governor, which is the country, and the Reserve Bank of India, which is the central banker, come together to treat this ailment. What has Reserve Bank of India done? They have cut interest rates. By how much? 1.1%. 110 basis point rate cut, including the one that we saw 2 weeks back, has taken the country's interest rates on the benchmark to 5.4%. Well, that's not enough. That's not enough because if you're in Italy or if you are a Conti food freak, if you're going to eat every day pasta and pizza, you're going to add only fat to your body. Malnourishment doesn't get cured. Sarka, I'm a South Indian tam bram. If I every day eat only curd and rice for dinner and lunch and maybe even breakfast, I'm only adding carbs to my body. My malnourishment is not addressed. So the rate cut has had one desired impact, that of making funds readily available. Banks have to start transmitting, and once that happens, that is when this malnourishment chain gets broken and you go back into a healthy baby. And why I say baby? Because we are emerging market. I would have said fat boy, fat girl if we were the US. So my view is that interest rates in India will come down further. There is more headroom, leg room, center room, front room for this rally to continue. But more importantly, if you put in money today and ask why is the NAV down, then the best place to be is in fixed deposit of Standard Chartered Bank, because that will only move straight line upward. It will not move lower. It is very important to understand and get confidence that an asset class which gives you upside participation, 10 years, 11% return, compounded annual 11% return. Show me which asset class has given you that kind of return. 8%, 8.5%, 9% real returns, that kind of an asset class, equities followed by fixed income, is the way to obviously stabilize wealth and grow wealth. There will be palpitations. I think it is important for all of us in this room to A, have the faith. I have this WhatsApp broadcast group, and I sent out a broadcast this morning which says that S&P 500, okay, which is the flagship equivalent for which we track as Nifty for the US, 4 stocks have contributed to 20% of the returns. And here, the same thing when it happens, we say, fund managers don't know how to manage money. There, it is a worse off scenario. So the point I'm trying to make is it is the same story everywhere. Whether it's in India, whether it's outside of India, we are a much better lot. We have a favorable demographics, we have a favorable policy, we have a stable government. Most of the countries like Indonesia don't even have that. So I think it's very important for us to A, keep the faith, have loads of patience, and more importantly, listen to your financial advisor.
Just on the result season has been volatile as always. The point here is, it is not that the first time that we are seeing that the earning cuts are in India. In last 7, 8, 10 years, what we have observed it, every time you expect next year earning growth to be 25%. and the real delivery is 5, 10, 15%. So this is nothing new that this time it is happening for first. It has always been happening. As long as you focus on your companies which are growing faster, you end up getting your returns. And that's why despite the lower earning growth, so if you just recollect how much has been EPS earning growth last year, before that, every time you would remember that every time people are talking end of the day delivery of single digit or early double digit. But then look at what is the 10-year CAGR returns in the equity. It is 10, 11%. So it is in line with the earning growth, and that what matters rather than talking about the companies which are falling and the companies which are not delivering. And that is where the differentiation comes.